Hey everyone, welcome back to our channel. Today we've got an exciting video lined up for you about the power of compound interest, so let's dive in. One of the most powerful concepts in finance and investing is the idea of compound interest. Often referred to as the eighth wonder of the world, compound interest has the potential to turn modest savings into significant wealth over time. The compound effect in investments isn't just a theoretical concept, it is a proven strategy that has helped countless individuals build wealth, even from small beginnings. In this video, we will explore what compound interest is, how it works, and why it's such a crucial tool for investors. We'll also look at practical examples and strategies to maximize the benefits of compounding over the long term. What is compound interest? At its core, compound interest is the interest on interest. This means that, unlike simple interest, which is calculated only on the principal amount, compound interest is calculated on both the initial principal and the accumulated interest from previous periods. As a result, the investment grows at an accelerating rate over time. The process of compounding can be summarized as follows. 1. You invest a sum of money, the principal. 2. Interest is earned on that principal. 3. In the next period, interest is earned on both the original principal and the interest that has already been added to it. 4. This cycle repeats, causing the investment to grow faster and faster as the interest compounds. This snowball effect makes compound interest one of the most powerful tools for building wealth. The longer you let your money compound, the more exponential the growth becomes. The magic of compounding over time. The key to unlocking the full potential of compound interest is time. The longer your money is allowed to compound, the greater the growth. This is because compounding works geometrically rather than linearly. Growth accelerates over time. To illustrate this, let's look at a simple example. Imagine you invest $1,000 at an annual interest rate of 10%. With simple interest, you would earn $100 each year, and after 10 years, you'd have $1,000 principal, $1,000 interest. However, with compound interest, the growth looks very different. Year 1, you earn $100, so you now have $1,100. Year 2, you earn 10% on $1,100, which is $110, bringing your total to $1,210. Year 3, you earn 10% on $1,210, which is $121, bringing your total to $1,331, and so on. After 10 years, your investment would grow to $2,594. That's $594 more than you would have with simple interest, simply by allowing your interest to compound. Over longer periods, the difference becomes even more dramatic. Real-life example: the power of starting early. To truly understand the power of compounding, it helps to see how starting early can make a significant difference in long-term wealth accumulation. Let's compare two investors, Alice and Bob. Alice starts investing $5,000 per year at age 25 and continues until she is 10 years, then stops. She never adds another penny to her investments after age 35. She earns an average annual return of 7%. Bob starts investing $5,000 per year at age 35 and continues until he is 30 years. He also earns an average annual return of 7%. Now, who will have more money at age 65? Alice. Even though Alice only invested for 10 years, her money had more time to compound. By the time she reaches 65, her investments have grown to approximately $602,070. Bob. Despite investing for 30 years, Bob's total investment grows to about $540,741. Alice ends up with more money than Bob, even though she invested far less, $50,000 compared to Bob's $150,000. Simply because she started earlier and let compound interest work its magic. This example highlights a crucial lesson: starting early can have a profound impact on your long-term financial success. The earlier you start investing, the more time your money has to compound, and the less you have to invest over time to reach your financial goals. The impact of interest rates on compounding. While time is the most critical factor in compounding, the interest rate or return on investment is also essential. Higher interest rates lead to faster compounding and significantly greater wealth accumulation over time. To illustrate this, let's compare two different scenarios. Scenario 1. You invest $10,000 at an annual interest rate of 5%, compounded annually, for 30 years. Scenario 2. You invest the same $10,000 at an annual interest rate of 8%, compounded annually, for 30 years. Scenario 1 result. After 30 years, your investment would grow to approximately $43,219. Scenario 2 result. After 30 years, your investment would grow to about $100,627. The difference between a 5% return and an 8% return might not seem significant initially, but over time, the impact of compounding at the higher rate leads to a much larger final amount. This demonstrates why it's essential to seek investments with the potential for higher returns, as long as they align with your risk tolerance and financial goals. Even small increases in your rate of return can lead to substantial differences in your wealth over the long term. Compound interest and dividend reinvestment. Another way to maximize the power of compounding is through dividend reinvestment. Many companies pay dividends to their shareholders, which represent a portion of the company's profits. Instead of taking the dividends as cash, you can reinvest them to purchase more shares of the company's stock. Reinvesting dividends allows your investment to compound even more rapidly because you're essentially buying more assets that will, in turn, generate more income. Over time, this reinvestment can lead to substantial growth in your portfolio. For example, let's say you invest in a company that pays a 3% annual dividend and the stock price appreciates by 5% per year. If you reinvest the dividends, your total return will be higher than just the 5% appreciation. Over time, the compounding effect of both capital gains and reinvested dividends can significantly increase your overall wealth. Many brokerage accounts offer automatic dividend reinvestment plan strips, which make it easy to reinvest your dividends without having to manually buy more shares. This is an effective way to take advantage of compounding without any additional effort on your part. Overcoming inflation with compounding. Inflation is the gradual increase in the price of goods and services over time, which erodes the purchasing power of money. To preserve and grow your wealth, it's essential to invest in assets that not only keep pace with inflation but outgrow it. Compound interest is one of the best ways to do this. When you invest in assets that offer a return higher than the inflation rate, the compounding effect helps your wealth grow in real terms, meaning you're increasing your purchasing power over time. For example, if inflation is 2% per year and your investments are compounding at 6%, your real return is 4%. This positive real return is crucial for maintaining and growing your wealth in the face of inflation. Historically, the stock market has been one of the most effective ways to outpace inflation, with average returns ranging from 7% to 10% per year over the long term. By investing in a diversified portfolio and allowing compound interest to work its magic, you can build wealth that not only withstands inflation but grows significantly beyond it. The importance of patience and discipline. While compound interest is a powerful tool, it requires patience and discipline to see its full benefits. Compounding works best over long periods, and it may take years or even decades to see substantial results. This can be challenging in a world where instant gratification is often prioritized over long-term gains. However, those who remain patient and disciplined in their investing approach are rewarded with exponential growth over time. The key is to stay committed to your investment strategy, consistently contribute to your investments, and avoid the temptation to withdraw or spend the money prematurely. It's also essential to avoid making emotional investment decisions based on short-term market fluctuations. Market volatility is inevitable, but long-term investors who stay the course and allow their investments to compound will often come out ahead. The compound effect in investments is a powerful tool for building wealth over time. By allowing your money to grow through compound interest, you can achieve exponential growth that far surpasses what's possible with simple interest or short-term gains. The key to unlocking the full potential of compounding is time. The longer your money compounds, the greater the impact. To maximize the benefits of compounding, it's essential to start investing as early as possible, seek investments with higher returns, and reinvest dividends and earnings. Patience and discipline are crucial, as the true power of compounding is realized over the long term. Remember, wealth building is a marathon, not a sprint. By understanding and leveraging the power of compound interest, you can achieve your financial goals and secure a prosperous future.